The trade that damages you most is often the one you can still justify afterward. You entered late, but the move was strong. You moved the stop, but the chart still looked alive. You added size, not because the rule called for it, but because the market seemed to be proving you right. Then, when the loss came, it did not feel like recklessness. It felt like judgment. That is the danger. A trader rarely loses discipline all at once. He loses it one small exception at a time. The market does not need you to be foolish every day. It only needs you to be vague at the wrong moment. A vague entry becomes a hopeful entry. A flexible stop becomes no stop. A promising setup becomes a personal argument with price. This is why your first systematic trading rulebook is not merely a list of tactics. It is a defense against the version of yourself that appears when money is moving, candles are widening, and your mind begins searching for permission. The rulebook is not there because you lack intelligence. It is there because intelligence, under pressure, often becomes negotiation. You must learn to notice the difference between a market signal and an emotional signal. Price breaking a level with volume is information. Your fear of missing the move is not information. A failed retest may matter. Your irritation after 2 losing trades does not. When you cannot separate these two, every chart begins to say what you need it to say. Look closely at your own behavior around decisions. Do you enter faster after a missed winner? Do you widen risk after a loss because the next trade has to work? Do you take profits early in clean trades, then give losing trades extra room to breathe? These are not personality flaws, they are patterns. And in trading, any pattern left unnamed eventually becomes a cost. A rulebook begins by forcing honesty into places where memory is unreliable. It asks before the trade, what condition must exist for action to be justified? It asks how much can be lost before the idea is proven wrong. It asks what will make you exit if the trade works, and what will make you stand aside if the market is unclear. Without those answers, you are not trading a plan. You are reacting to movement. The market will always offer reasons to break structure. It will move without you. It will reverse after stopping you out. It will reward a bad decision often enough to make the lesson difficult. That is why the rulebook must be built around behavior, not fantasy. It must describe what you will do when the chart is clean, when it is ugly, when you are wrong, when you are right, and when you are tempted to invent a new rule in the middle of the trade. So before we speak of entries, exits, risk, filters, and review, understand the first principles. A systematic rulebook is not designed to predict the market perfectly. It is designed to keep your decisions consistent enough that the market can be judged honestly. And that is where the real work begins, not with finding the perfect rule, but with learning which parts of your trading need rules in the first place. You do not meet the market as one fixed person. There is the trader who studies the chart after the close, calm and reasonable, seeing the mistake clearly. Then there is the trader who is watching price move without him, feeling the pressure rise, telling himself that this one may be different. Both traders live in the same mind. The rulebook is built because the second one cannot be trusted to borrow the judgment of the first. This is not a question of character. It is a question of condition. When money is at risk, the mind begins to protect itself before it begins to think clearly. A loss makes you search for repair. A missed trade makes you search for entry. A quick profit makes you search for certainty. Once that state takes hold, the chart is no longer just a chart. It becomes a way to relieve pressure. That is where many traders misunderstand discipline. They think discipline means feeling calm while the market tests them, but calm is not always available. The tape can move fast. The candle can break before you are ready. The position can turn against you before you have accepted the risk. If your method depends on being emotionally perfect, it is not a method. It is a hope. The purpose of a rule book is to reduce the power of the moment. It gives the calmer version of you a voice before the pressured version takes control. It does not remove emotion. It removes the need to make certain decisions while emotion is at its strongest. This matters because the worst trading decisions often arrive disguised as judgment. They do not feel impulsive from the inside. They feel necessary. Notice what happens after you lose. The next setup may appear brighter than it really is because you want your account to return to where it was. Notice what happens after you win. You may begin to treat the next trade as if the market owes you continuation. Notice what happens after you miss a move. You may stop asking whether the opportunity is still valid and start asking whether there is any way to get involved. In each case, your state changes what you see. The market does not have to force you into error. It only has to present movement when you are vulnerable. If you are angry, you will find a reason to act. If you are afraid, you will find a reason to hesitate. If you are overconfident, you will find a reason to increase exposure. The chart may be the same, but the interpretation changes because the interpreter has changed. This is why you must learn to recognize your trading states. Not to shame yourself. Not to pretend you can eliminate them. You recognize them because every state has a predictable temptation. After a loss, the temptation is to recover. After a missed move, the temptation is to chase. After a streak, the temptation is to expand. After boredom, the temptation is to invent opportunity. Once you know the temptation, you can design protection before it is needed. A strong rule book should speak most clearly at the points where you are least clear. It should tell you what happens after 2 losses. It should tell you what you are not allowed to do when you miss the first move. It should tell you when you must stop trading, not because the market is closed, but because your judgment is no longer clean. These rules are not punishments. They are circuit breakers. The beginner often resists this because he wants freedom. He wants to feel that he can adapt to anything. But without structure, adaptation becomes excuse-making. The more freedom you give yourself under pressure, the more your current mood becomes part of the system. And once mood enters the system, results become harder to read. You can no longer tell whether the rule failed or whether you abandoned it. So the first work is not to write clever rules. The first work is to understand where your judgment changes. Where do you become urgent? Where do you become hopeful? Where do you start bargaining with price? Mark those places carefully, because those are the places where your rule book must be strongest. Only after that can an idea become something sturdier than intention. Something written clearly enough that, when the market begins to move, you know exactly what action is allowed and what action is not. A trading idea is harmless until you try to act on it. On paper, an idea can sound clear. Buy strength near a breakout. Sell weakness after a failed rally. Wait for confirmation. Avoid bad conditions. These words feel useful because they point in the right direction, but they are not yet rules. They still leave too much space for interpretation at the exact moment when interpretation becomes expensive. A rule must be observable. It must describe something the market either has done or has not done. If your rule says, "Enter when price looks strong," you have left the door open. Strong compared to what? The prior high? The opening range? The last pullback? The volume behind the move? Unless the condition can be seen and checked, it is not a rule. It is a preference wearing the clothes of a rule. This is where execution begins. You take the rough idea and press it until it becomes specific. What market must be traded? What time frame is being read? What level matters? What must price do before action is allowed? Must the candle close, or is an intrabar break enough? Is the entry taken at the level, after a pullback, or only after confirmation? Each answer removes one small area of confusion. Enough clear answers, and the trade begins to stand on its own. The purpose is not to make the market simple. The purpose is to make your behavior precise. Price will always move with uncertainty, but your instructions cannot be uncertain. If the market breaks a level and immediately returns below it, do you enter, wait, cancel, or reassess? If the setup appears 5 minutes before a major news release, is it valid or not? If the entry is missed by a small distance, are you allowed to chase, or is the trade gone? These details matter because execution fails most often in the spaces the trader forgot to define. A useful rule also tells you what is not a trade. This is often more valuable than the entry itself. Beginners write rules only for action, because action feels like progress, but a serious rule book must define rejection. A setup that forms too late, too far from the level, without the required confirmation, or outside the chosen session is not a weaker version of the trade. It is no trade. If you do not define that boundary, almost every chart will eventually become acceptable. The test of an execution rule is whether another disciplined trader could read it and act nearly the same way. Not perfectly, because trading will always contain judgment at the edges, but close enough that the rule produces consistent behavior. If two traders read your rule and one enters early, one enters late, one skips the trade, and one doubles size, the rule has not been written. It has only been suggested. You must also separate preparation from execution. Preparation is where you think, compare, plan, and mark the areas that matter. Execution is where you follow the conditions already chosen. When these two are mixed together, the live chart becomes a workshop, and that is dangerous. You begin constructing the trade while the trade is already forming. Because price is moving, every new thought feels urgent. Because it feels urgent, weak rules get accepted. This is why the first systematic rulebook should be written in operational language, not beautiful language, not market commentary, commands, conditions, limits. If this happens, I do this. If this does not happen, I stand aside. If price reaches this area without this behavior, the setup is invalid. The more plainly the rule is written, the less room there is for invention when the candle is moving. Do not be surprised if your first rules feel too strict. That is often a good sign. A loose rule may give you more trades, but it gives you less information. A precise rule may keep you out of many moves, but it teaches you exactly what you are testing. And once execution becomes repeatable, your results begin to mean something. Only then can the next question be asked with any seriousness, not whether the rule feels right in the moment, but whether the arithmetic behind it can justify the risk. A rule can look intelligent and still have no right to be traded. It may catch beautiful moves. It may produce clean entries. It may even win often enough to make you feel competent. But the market does not pay for elegance. It pays according to arithmetic. If the average loss is too large, if the average win is too small, if the rule appears too rarely, or if the losing streaks are too deep for your capital, the idea may be attractive and still be unfit for real money. This is the first hard lesson of the numbers. Being right is not the same as being profitable. A trader can win 6 times out of 10 and lose money if the losses are larger than the gains. Another trader can be wrong more often than right and still advance if the wins are allowed to outweigh the losses. The market does not ask how many times you felt correct. It asks what each correct decision earns, what each incorrect decision costs, and how often both are likely to appear. That relationship is expectancy. It is the quiet measure beneath every rule in your book. Expectancy asks one plain question over many trades. What does this rule tend to produce after winners and losers are both counted? Not over one trade, not over one lucky week, over a meaningful series. A rule with positive expectancy does not promise comfort. It promises that the numbers have a reason to work if you execute them consistently. This is why sample size matters. 10 trades can flatter a weak rule or insult a strong one. A short run is full of noise. A few clean winners can make a fragile idea look powerful, just as a few early losses can make a valid rule look broken. If you judge too soon, you are not measuring the rule. You are measuring randomness. And randomness, when mistaken for evidence, leads traders to abandon what should be kept and keep what should be abandoned. You must also know the shape of the rule. Some systems win often but earn little each time. Their danger is one large loss that erases many small gains. Some systems lose often but rely on occasional large wins. Their danger is psychological pressure during long stretches of small failures. Neither structure is automatically superior, but you must know which one you are dealing with, because the wrong expectations will cause you to interfere with the rule before the mathematics has time to express itself. Risk of ruin is the number most beginners ignore because it speaks in a cold voice. It asks how much damage your account can take before the game becomes impossible to continue. A rule may have an edge and still destroy you if the position size is too large for its normal drawdown. That is not bad luck. That is poor arithmetic. If a routine losing streak can force you out, then your risk was built for confidence, not survival. So your rule book must contain more than entry and exit language. It must contain the financial boundaries of the rule. What is the fixed risk per trade? What is the maximum loss for the day, week, or sequence? What is the minimum reward the trade must offer before it is worth taking? How many trades are needed before the rule can be judged? These questions protect you from treating a market idea as if it were proven before the numbers have spoken. You should learn to think in distributions, not predictions. One trade is only one event. A series of trades is where the rule reveals its nature. Inside that series will be winners, losers, scratches, missed opportunities, strong periods and weak periods. The rulebook must prepare you to evaluate the whole collection, because the edge, if it exists, lives in the collection. It does not live in the next trade alone. The beginner often wants certainty before acting. The professional wants favorable arithmetic repeated under controlled risk. That difference changes everything. Certainty makes you search for perfect setups. Arithmetic makes you ask whether the reward justifies the exposure over time. Certainty makes each loss feel like a contradiction. Arithmetic makes each loss part of the cost of testing the rule. Before a rule earns capital, it must earn belief through numbers. Not blind belief, measured belief. You need to know what the rule wins, what it loses, how often it acts, how badly it can draw down, and how much evidence is enough to continue. Without that, you are not building a system. You are decorating an opinion. And once the arithmetic shows that a rule may deserve attention, the next task is to understand the kind of market behavior that gives those numbers a reason to exist. A rule does not fail only because it is badly written. Sometimes it fails because it is being used in the wrong market. The same entry that works well in a clean trend can become expensive inside a range. The same breakout rule that captures momentum during expansion can lose repeatedly when price is only probing above a level and falling back. The same pullback that offers opportunity in an orderly advance can become a trap when the larger move has already lost participation. The rule may not be foolish. The condition may simply be wrong for it. This is why a rule book must begin with market behavior, not just price location. A level by itself is not enough. A candle pattern by itself is not enough. You must ask what kind of market is forming around the setup. Is price advancing with acceptance, or only stretching into exhaustion? Is it rotating between boundaries, or pressing steadily in one direction? Is volatility expanding with purpose, or widening because both sides are uncertain? The market is always giving information, but not all information belongs to the same play. A systematic trader does not treat all movement as equal. He separates behavior into conditions. In a trending market, strength tends to produce more strength because traders who are underpositioned keep buying pullbacks, and traders who are wrong are forced to cover. In a range, strength near the upper boundary can produce weakness because buyers are late and sellers have a clear place to defend. The price may rise in both cases, but the meaning of the rise is different. This difference matters because every rule has a natural environment. A trend continuation rule needs persistence. A mean reversion rule needs overextension and a boundary. A breakout rule needs pressure building before release. A range rule needs defined edges and failed attempts to escape. A volatility expansion rule needs compression before movement. If you do not name the environment, you will ask one rule to solve many different problems. No rule survives that burden for long. Market behavior is also revealed by what price refuses to do. If price breaks higher but cannot hold higher, that tells you something about acceptance. If selling appears but cannot push price into new lows, that tells you something about absorption. If each pullback becomes shallow and each advance reaches farther, that tells you participation is changing. These observations are not predictions. They are context. Context tells your rule whether it is operating with the market's character or against it. The beginner often sees a setup first and then searches for reasons to take it. A better process is to identify the condition first and only then ask which rule, if any, belongs there. This reverses the order of judgment. Instead of saying, "Here is a pattern, can I trade it?" you ask, "What is the market doing? And does my rule book have permission to act in this condition?" That one shift prevents many trades that look acceptable in isolation, but are poorly matched to the environment. Your rulebook should therefore define the market state before it defines the trade. Write down what a trend looks like for your method. Write down what a range looks like. Write down what compression looks like before expansion. Write down what would prove that the condition is absent. The purpose is not to label the market perfectly. The purpose is to avoid using a rule where its logic has no support. This requires humility. The market will often be unclear. It will begin as a trend and settle into rotation. It will appear to break out and then return to balance. It will compress for longer than expected. A rulebook must allow for that uncertainty by saying, in plain terms, when the environment is not suitable. Standing aside is not a failure of courage. It is an admission that a rule without the right condition is only a guess with structure around it. When your rule is tied to market behavior, you stop asking whether price can move. Price can always move. The better question is whether the current behavior gives your specific rule a reason to work. That is a more serious question, and it narrows the field. It keeps you from forcing trend logic into a range, breakout logic into exhaustion, and reversal logic into strong continuation. Once the market condition is named, the next challenge becomes sharper. Even when the environment is right, you still must know whether the chart is giving you a true signal or merely giving you an excuse to act. A chart can look interesting long before it becomes tradable. That difference is where many decisions begin to weaken. You see movement, then you see a level, then you see a reason. Before long, attention has become intention. But interest is not a signal. A market that catches your eye has not yet earned your risk. Until your rulebook separates curiosity from permission, you will keep mistaking a developing idea for an actual trade. A true signal is not something you want to be present. It is something the market has objectively delivered. It can be checked against your conditions without argument. The level was reached or it was not. The close confirmed or it did not. The range broke or it remained contained. The required behavior appeared or it was absent. A signal has weight because it does not depend on your need to participate. Permission is different. Permission is the rulebook saying that action is allowed, but not forced. This distinction matters. A signal may appear, yet the trade may still fail other requirements. The distance to the invalidation may be too wide. The move may already be extended beyond the acceptable entry area. The setup may appear outside the time or conditions you plan to trade. In that case, the market has shown something, but it has not offered you a proper decision. Impulse enters when you collapse these stages into one. You notice movement and act as if noticing is enough. You see partial evidence and treat it as confirmation. You feel the trade forming and enter before the rule has given permission. The danger is not that impulse always feels wild. Often it feels efficient. It tells you that waiting will cost you. It tells you that the full rule is unnecessary this time. That is how a decision becomes unclean. A serious rulebook slows the path from attention to execution. First, the market earns your attention. Then it earns your preparation. Then it earns permission. Only after that does it earn an order. Each stage should have its own gate. If the first gate fails, you stop watching closely. If the second gate fails, you do not prepare. If the third gate fails, you do not execute. This is how you keep a chart from pulling you forward one small compromise at a time. Ask yourself what must be true before you are even allowed to consider a trade. This is not the entry rule. It is the attention rule. Perhaps price must be near a preselected area. Perhaps the move must occur inside the session you study. Perhaps volume, volatility, or range must meet a minimum condition. The purpose is to prevent every flicker of movement from becoming a candidate. A trader who considers too much will eventually justify too much. Then define what turns attention into preparation. Preparation means the trade is close enough to plan, but not ready enough to enter. At this stage, you should know where the idea is wrong, where the entry would be acceptable, and what would cancel the setup before entry. If you cannot define those things before the signal appears, you are not preparing. You are waiting for pressure to make the decision for you. Finally, define the execution gate. This is the narrow point. The exact condition must appear, and if it appears poorly, late, or outside the acceptable area, there is no trade. This is where your rulebook must be firm. A near signal is not a signal. A late signal is not the same trade. A trade that needs explanation after the fact was usually unclear before the fact. The value of decision gates is that they reduce argument. They keep you from asking, "Do I like this?" and force you to ask, "Which gate has this passed?" That question changes the quality of your trading. It turns the live chart from a place of persuasion into a place of verification. You are no longer searching for permission while price is moving. You are checking whether permission already exists. This is not mechanical stiffness. It is orderly judgment. You still observe. You still interpret. But you do not allow interpretation to become action without passing through structure. A rulebook built this way does more than tell you when to trade. It tells you how a decision is allowed to mature. And once those decisions are properly staged, the next weakness appears outside the trade itself. The daily operating habits that decide whether your rulebook is ready before the market begins to move. A rulebook is weakest when it is open for the first time after the market has already begun to move. By then, the session is alive. Price is printing, alerts are firing, spreads are changing, and the mind begins to hurry. If you have not prepared before that moment, the rulebook becomes less like an operating manual and more like a reference book you consult while the building is already on fire. The rules may be sound, but your access to them is late. Professional habits exist to reduce that lateness. They bring the rulebook into the day before the day has a chance to surprise you. This does not mean filling a desk with complexity. It means knowing what deserves attention before the open, what levels matter, what conditions would make the day tradable, and what conditions would make patience the better choice. Preparation is not prediction. It is arranging your mind so the market does not arrange it for you. A serious trader begins by narrowing the field. There are always too many symbols, too many headlines, too many price movements, and too many possible explanations. If you try to watch everything, you will understand little. Your routine should decide what is worth watching and what is only noise. A focused watch list is not a small ambition. It is a way of protecting judgment from overload. From there, you mark the areas where decisions may become necessary. Not every line on a chart is important. A level matters only if your rulebook knows what to do there. This is the difference between decoration and preparation. If price reaches a marked area, what are you looking for? If price rejects it, what does that mean? If price passes through it cleanly, what changes? A prepared level should carry instructions, not just attention. Scenario planning is the next habit. Before the session begins, you should have a few simple paths in mind. If price opens strong and holds above a key area, what kind of day may be forming? If it opens weak and cannot reclaim a prior level, what does that tell you? If it stays trapped inside a narrow range, what will you refuse to do? These scenarios are not forecasts. They are rehearsals. They keep you from inventing your response while price is forcing the issue. A checklist may feel too plain for a trader who wants to be sharp, but plain tools often protect sharp minds. The checklist asks whether the market, setup, risk, timing, and execution conditions are all present. Its value is not intelligence. Its value is interruption. It interrupts the rush between seeing and acting. It makes you pause long enough to confirm that today's trade belongs to today's plan. The routine after the session matters just as much, but not as a place for regret. The end of the day is where you record whether you followed the operating process. Did you trade only the names on your list? Did you respect the planned areas? Did you wait for the conditions you named beforehand? Did the session develop in a way you had considered, or did it expose a gap in your preparation? These questions improve the next session because they show where the routine held and where it was thin. Without habits, a rulebook depends too heavily on memory. Memory is selective after the fact and unreliable during speed. A routine makes the rules visible before they are needed. It turns preparation into something repeatable, not something you perform only when you feel serious. That is the quiet mark of professionalism, doing the necessary work before urgency makes it obvious. This is also how you reduce avoidable surprise. You cannot know what the market will do, but you can know what you will watch, what would matter, and what would disqualify action. When those things are settled early, the session becomes less of a chase. You are no longer trying to become prepared after opportunity appears. You are already standing in the right place, waiting to see whether the market gives you a reason to proceed. But preparation only carries you to the edge of the trade. Once you are in, a different pressure begins, and the rule book must speak clearly there as well. The trade is not finished when you enter. In many ways, that is when the real test begins. Before entry, you can be calm. You can mark the chart, name the condition, and wait for the signal. But once the position is open, every tick begins to speak directly to your account. A small profit asks to be protected. A small loss asks to be forgiven. A fast move asks you to interfere. If your rulebook goes silent after entry, the trade will be managed by whatever feeling is strongest at the time. This is why entry rules are never enough. The entry only defines how the risk begins. Trade management defines how the idea is handled while it is alive.